Okay.
Okay, folks, so I'm going to get started. And two things. One is I sent you a little test. Even if you didn't see it, you're going to see it show up. It's pretty easy, so you can work along. And the second is, today we're going to talk about acquisitions. And if you look at the title for my session, you can already see my biases showing. So let me give you a little bit of history for this title. About 20 years ago, a student of mine started a business, and his business was he ran seminars in New York City for CFOs, CEOs, analysts. So he calls me one day and he says, look, I'm running a seminar on acquisitions, on M&A, for a group of CFOs of companies that do a lot of acquisitions. In other words, think of them as serial acquirers. These are companies that do an acquisition of the month. So he said, I'm doing an M&A all-day session for these CFOs. Would you be willing to come in and talk to them? And I said, are you sure you've got the right guy? Because my biases about acquisitions are out there for everybody to see. I think more value is destroyed with acquisitions than any other action that companies take. So he said, no, I'd like you to come in for the last 30 minutes of the day, because for the rest of the day, they're going to be hearing from investment bankers. And what investment bankers think about M&A, right? It's the mother lode. It's basically how you make money. And he said they're going to be hearing a lot about why you should do M&A, and I'd like you to come in as kind of a counter. And I said, sure. And I showed up and I put up the cover page, and this is what it said, and it kind of captures what I think about acquisitions. Basically, it says 7 steps back to sobriety. I think of acquisitions as an addiction. And here's what I mean by that. When companies start to grow with acquisitions, it's very difficult for them to go back to growing the old-fashioned way. The old-fashioned way is you take a lot of projects, you make sure you do the analysis, you make the projects come to fruition. It's so much quicker going and doing a $5 billion acquisition. So it's an addiction, and like every addictive product, it comes with its own ecosystem that makes money off the addiction. So you know who makes money off the acquisition addiction? It's bankers, it's consultants. So here's what happens. You have a company, it's become a slow growth company, and a banker shows up and says, I can make you young again. Here, all you have to do is do this acquisition. So there is a tremendous force that pushes companies towards doing acquisitions. And I'm going to suggest that it's not a value creating force. So I'm going to start off by listing out what we've learned about acquisitions in 50 years of looking at acquisitions. First, let's focus on the 2 companies involved in an acquisition. There's an acquiring company and a target company, right? If you look at what happens around the announcement of an acquisition, it's very easy to highlight which companies' stockholders are the winners and which ones are the losers. So I'm going to throw it out to you. This is an obvious one. Let's get this out of the way. See this red line? This is what happens to the stock price of a target company around the day an acquisition is announced. See this 0 right here? That's the day the acquisition is announced. And you can see on the day the acquisition is announced, the stock price jumps. In fact, the target company's stock price starts to drift up in the days before the acquisition. How can that be? If the acquisition is announced on April 15th, why is the stock price drifting up on the April 1st, April 2nd, April 3rd? What explains the drift in the stock price? What do you think is happening? Max, what do you think is happening?
Maybe there are information on the market that people kind of notice there is going to be an acquisition.
Technically, it's illegal, right? But basically, what it's telling is there's leakage of information. People are finding out who those people are. We will leave a name. But the SEC actually that's one of the things the SEC watches for insider trading, is how much the stock price starts to drift up before the acquisition. And then they send their research teams out, go find out who's been doing the trading. And if you've been doing it stupidly, like if you're the CEO and you put in you bought 1 million shares just 7 days, they're going to catch you. So it's the drift there shows you that information is leaking. So basically, target company stockholders clearly benefit. The stock price on average jumps 15, 20, 25%. See this blue line? That's what happens to the bidding company's stock price. There's day 0. If anything, there's a slight drift downwards, right? It's only about 2%. But remember, the typical acquiring company is 10 to 20 times larger than the typical target company. So the 2% drop in the acquiring company's stock price in market cap terms might be as much as the increase in the target company's stock price. A lot of M&A deals are zero-sum deals. What I mean by that is we add up the value of the acquiring and the target company before the acquisition is announced, and after, the sum of the values don't change, but what you see is a transfer of value from the acquiring company stockholders to the target company stockholders. Sebastian?
Yeah, I had a question. Doesn't the effect on the bidder's stock price depend if the acquisition is financed with cash or stock?
We'll come back and look at it because there are variations. It depends on whether the acquisition is financed with stock or cash. It depends on whether the acquisition is of a big company buying a small company or whether it's a merger of equals. So there are a bunch of variables and we'll come and look at the differences. But across the board, target company stock price jump. What's your prior? Do you think it jumps more with a stock acquisition or less with a stock acquisition?
I think it jumps less with the stock acquisition and more with the cash acquisition.
Okay, so let's see if that in fact turns out, because I think that you're thinking about it from the perspective of the target company shareholders. Let's see how this plays out when you look at the actual evidence. It's kind of mixed. It depends on the size of the acquisition, but we're going to see cash versus stock. We're going to see big versus small. But there are a bunch of differences we'll come back and isolate. But across the board, target company stockholders clearly are the winners. And acquiring company stockholders at best kind of break even or perhaps even lose, even on stock acquisitions. So the bottom line is, on the announcement date, it's quite clear that target company stockholders are winning and acquiring company stockholders are losing. Of course, we ask the managers of these acquiring companies, because clearly, if you're a stockholder in an acquiring company, you're pretty pissed off, right? Your stock price went down. If you ask managers, why do you keep doing this? Their response is, hey, the market doesn't see what we see. What do acquiring company managers see? They see the projections of synergy in the future and all this great stuff that's going to happen. They say, hey, the stockholders at our companies don't see what we see. So there's a second set of studies I'm going to reference that looks at what happens 5-10 years after an acquisition. So both KPMG and McKinsey do these studies. And here's what they find when they track acquisitions 5 or 10 years after. And remember, when these acquisitions are marketed to shareholders, the shareholders are told, this is going to be amazing for you, there's going to be synergy, there's going to be control, we're going to get all kinds of great earnings and cash flow benefits. So here's what McKinsey asked about acquisitions. It looked at acquisition programs at companies and asked, does the return on capital and these acquisitions exceed the cost of capital? It's kind of a very simple test we ask about any project, right? So they ask that about acquisitions. If acquisitions clearly create value, there's synergy and control, you know what you should see? The return on capital on acquisition should exceed the cost of capital. Second question McKinsey asks is, do the acquisitions help the parent companies outperform their peer group? So if your argument is, by doing this acquisition, I'm going to become a stronger company, here's where it should show up. Your margin should go up relative to the rest of the sector. Your return should go up. When they looked across companies, half of all acquisition programs failed at least one test and a quarter failed both. So McKinsey found that many of these acquisition programs didn't live up to the promise. KPMG did the same test on a much larger sample in the late 1990s. And here's what they focused on. They focused on that magic word here in every acquisition, synergy. And they asked a question, how often does synergy show up in a merger? And you know how you measure it, right? You look at the combined firm's earnings before the merger and the combined firm's earnings 3, 4, 5 years from the merger. And remember, if there's synergy, the combined firm's earnings after the merger should increase because you're getting all these additional benefits. They concluded that in 83% of cases, there is either no synergy or reverse synergy. Think about that. In 1 in 6 cases, only in 1 in 6 do you actually see the benefits of synergy. In 5 in 6, you either see no synergy or reverse synergy. You're saying, what's reverse synergy? It's very perverse. 2 companies come together and the combined company actually earns less than the 2 companies would have individually. So synergy is really elusive. Everybody talks about it, but it doesn't seem to show up. And here's the final piece of evidence that mergers don't work even in the long term. You know that about half of all acquisitions get reversed within 10 years of the original acquisition. You know what I mean by reversed? A company A buys company B with all kinds of promises. 7 years later, company A divests itself of company B, saying, we should never have done that. That's the ultimate admission of failure. So the bottom line is, whether you look on the announcement date or whether you look at the long-term performance, most mergers don't work. Now here's the bad news. That disease used to be a developed market disease, primarily US companies. Now, of course, 20, 25 years ago, if you looked at acquisitions, developed market companies bought emerging market companies. So we picked a country, let's pick India. Indian companies were targets of acquisitions. Kraft Heinz would come to India and buy a company. Why? Because the US companies, the market cap, Indian companies were small and cheap. Now, the worm is turned, right? Indian companies now are just as likely to be acquirers as there are targets. Take just the Tata Group, right? Tata Steel bought Chorus. Tata Motors bought Jaguar Land Rover. And the problem is, the disease that we've seen with US companies seems to be spreading to emerging markets. This is from a study of Indian companies that acquire US targets. The Indian companies, now the acquirer, the US companies the target between 1999 and 2005. And here's what you see. Right after the announcement of the acquisition, the Indian company's stock price actually continues to go up. You're saying, this is good. Indian companies are being smarter than US companies. And then it starts to fade. And around a year after the merger, Indian stockholders seem to realize that the Indian company paid too much. I mean, Tata Steel paid way too much for Chorus Steel. Tata Tea paid too much for Tetley Tea. I mean, this is something that is not just restricted to US companies. It seems to be a global phenomenon with M&A. Wherever you see M&A, acquiring companies seem to pay too much, promise too much, and deliver too little. But here's I think, the troubling aspect. We've known this for 40 years, but nothing changes. What have we known? We've known that M&A doesn't work. It doesn't create value. And you'd think that with learning, people would do it less, but it doesn't seem to change. Companies continue to do M&A with the same promises they made 10 years ago, 20 years ago, 30 years ago, deliver the same bad results they did 10 years ago, 20 years ago, 30 years ago, and they keep continuing to do it. If the definition of insanity is you keep doing the same thing over and over and over again, expecting a different outcome, clearly the M&A process is a little insane. So here's my reading of it. There's something that must be screwed up in this process. This is a process problem. If you see the same mistake being repeated over and over and over again, decade after decade, there's something wrong with the process. So let me first, I want to throw that question to you. What do you think about the M&A process? Makes it so vulnerable to big, bad mistakes. Why? What is it about the process that you think has gone wrong? Anybody want to try? Connor?
Yeah, I think it really just comes up with the incentive alignment. And when you're paying bankers more for finishing a deal, they're more inclined to make the numbers work for the deal to actually happen.
Okay.
And I think in one of your things you kind of showed like they make 10 million more if the deal goes through. So obviously the bankers who don't really have any risk on their part.
Okay. So in fact, Connor, let's step it back a moment. Describe to me how a typical friendly acquisition happens today. So how does the process start? You have an acquiring company that's interested in acquiring some other company. So they go to a banker, right? So you now have the acquiring company's managers, they've hired bankers. Remember, this is a friendly merger. They approach the target company and say, we'd like to buy you. The target company hires bankers as well. You have 4 people in the room. You have the acquiring company's manager, the acquiring company's banker, the target company's manager, the target company's banker. You talked about incentives. What does everybody in the room want as an outcome? They want the deal to go through. There's nobody there who's going to be asking tough questions because everybody there wants the deal to go through. The bankers obviously want to the deal to go through because they make money if the deal goes through. They make nothing if there's no deal. But why do the managers go along? I mean, after all, they're spending their shareholders' money, right? So why is it that they go along? We can't just blame the bankers. So why don't the managers, the acquiring company managers, push back more?
You say that no one else?
I'm sorry, you broke.
Yeah. So I think it's really comes from it's you kind of touch on it a little bit. Once you start acquiring, you kind of lose the ability to have the organic growth, and it's kind of a lazy path towards growth and to keep your competitive advantage, keep your market size, without really having to come up with a real creative solution internally.
And there's 3 more words you need to add: other people's money. And they're spending other people's money, right? Which is, managers don't spend their money, they spend shareholders' money. And of course, they want to build empires, they've already made a decision that this is what they're going to grow. You have a problem in the M&A process, which is the managers don't have enough of an incentive to take care of other people's money. You have bankers who want the deal to go through. And not surprisingly, if you have a bad deal, nobody wants to stop it. So we'll come back later and talk about how we might want to change this process. In fact, let's open it up now. What do you think would be a more sensible way to structure this process? Because right now, here's the problem. The deal makers are also the deal analysts, right? The bankers who make money in the deal are also the ones who advise you on whether you should do the deal. So that's a conflict of interest. What's a very simple fix we can make to the process that'll break up that conflict of interest? Dave?
Maybe involving the board of directors inside the process of deciding.
They already are. They just go along because they get bulldozed. Because remember, this goes back to corporate governance. Who sits on the board? Whoever the CEO likes on the board, right? So don't expect the board of directors to come riding to the rescue because they just go along. But
shareholder. Someone said shareholder vote. Maybe that one.
Let's talk about the mechanics of the process. Does the deal maker also have to be the deal analyst? Somehow in the US, this has become the way M&A gets done. The banker who does the deal, who does the deal, also does the valuation projections for the deal. Somehow that became the practice. I think at the minimum, we need to separate the 2 processes. You know what I mean by separate the 2 processes? Bankers can be great deal makers. Let them do the deal making. But the deal advice should come from somebody who does not have a stake in the deal. No. And I've always been surprised at how slow it is that this idea is. I mean, Singapore is one of the countries that's talking about making this actually part of the process. Saying if you're the banker who is going to be doing the deal, you cannot be also the person telling the management whether they should do the deal or not, because there is an inherent conflict of interest. So I think that, we have to talk about process here, because as long as the process stays where it is, nothing I say, nothing you say is going to stop companies from doing what they're doing now. So we'll come back and talk more about process, but I think the process is part of the problem. So Connor actually suggests that maybe we should have a retainer which has nothing to do whether the deal goes through or not. That's a good idea. Why should you have a fee that is contingent on whether the deal goes through? But unfortunately, for that to happen, the appraisal part and the deal making part have to be separated. So there's an opening here I think we can think about, and maybe it'll change in your lifetime, but it hasn't changed in mine. So here's what I'd like to do. I'd like to talk about some of the processes, or some of the things that I find in acquisition valuation that drive me crazy. The way I describe M&A valuations, it's where good principles go to die. If there's a funeral home for good valuation principles, it'll be an M&A. And here's 7 sins that I see in acquisitions. And the test I sent you is going to be built around these sins. Here's the first sin. It's called risk transference. What is risk transference? An acquiring company looks at a target company and values the target company using its cost of capital, its risk characteristics. We'll come back and talk about why companies do it and what kind of mistakes this can lead to. Second is what I call debt subsidies. What form does this take? You're an acquiring company. You're a AAA or a AA rated acquiring company. So you can borrow money at a really low rate. But because you can borrow money at a really low rate, you're willing to pay a premium for a target firm. I'm going to call that a debt subsidy. I'm going to talk about why that's wrong and why by doing that you're transferring wealth from your shareholders to the target company shareholders. The third is this magical word control. Now, I told you early in this class that one of the things that bankers do, especially in M&A, is they value a company and add a 20% control premium. I'm going to show you where that 20% control premium came from that bankers use, why it's so stupid to have a 20% control premium, and how you should actually be valuing control. Fourth, I want to go back to synergy. There's this canard that we in finance don't think synergy has any value. That, on the contrary, synergy has value, but to value it, you got to do the hard work. What hard work? You got to tell me what form the synergy will take. Higher revenue growth, lower costs. And I have to do the hard work of converting that into cash flows and a value. I'm actually going to value synergy, but I'm also going to talk about why many in M&A deals, people don't even try. Synergy becomes a plug variable. Fifth, I'm going to talk about how a lot of M&A is pricing. Remember we talked about valuation versus pricing? In M&A, this goes crazy. It's pricing in its worst form. You'll have transaction multiples, exit multiples. We talk about what can go wrong with M&A pricing. The sixth said, in many M&A deals, I'm convinced that the decision gets made first. The analysis follows. You know what I'm talking about? Company A decides to acquire Company B. And then they go to a banker and say, hey, come up with numbers that justify this transaction. It's not the way it's supposed to be, but the verdict comes first, the trial comes afterwards. And finally, when M&A deals go bad, and a lot of them go bad, and they go terribly bad, billions get lost, it's amazing that nobody seems to be held accountable. The acquiring company managers don't get held accountable, the bankers don't return their fees, nobody seems to think it's their fault. So let's start with, so as I go through, here's what I'd like you to do. I'm going to put you through tests, and I'd like you to be honest with yourself. I can't come and check on you. See if you pass each test. And I don't know how many of you are any of you planning to be working in M&A after you graduate? I mean, it might be up in the air still. Any M&A? Connor, you're going to be in M&A? Okay. And so basically, I'll make a deal with you. It can be an informal deal. If you fail more than 5 of these 7, I'll give you leeway to fail at least 2. If you fail more than 5 out of the 7, you need to think about reconsidering. In fact, that's your offer I made to those serial CFOs, and most of them failed 4, 5, 6 out of these tests. I think you guys are going to be okay because your foundations, your first principles should be more solid. So you ready? Let's start. So many of these numbers, you don't need a calculator, you don't need a computer, you can do it in your head. I have a target firm for you. The target firm has 100 million in revenues, 80 million in operating expenses, 20 million in operating income. It has 8 million in taxes, 12 million in after-tax operating income. So this is what the numbers look like last year. Assume that this firm will generate this $12 million operating income every year forever with zero growth. That its cost of equity is 20%. It's a very risky company. What is the value? And the firm has no debt. What's the value of equity in this company? What's the value of the company overall? Notice it's same income forever. You're saying, but you haven't given us capex and depreciation and working capital. Dave, what's the value of this company?
60.
60. You're right. Lead me through how you got 60. What's in your numerator?
It's the after-tax operating income.
So why aren't you subtracting out reinvestment? What is it about this particular company that leads you to ignore reinvestment?
Because we're calculating, first of all, we're using the cost of equity and not cost of debt.
No, but there's no debt. So your cost of equity will be your cost of capital. But
there's no growth.
Exactly. You got it. When you have no growth, with reinvestment, you need nothing. If I put in a growth rate, you couldn't have used the 12 million, right? You'd have to then compute a reinvestment rate and a free cash flow to the firm. But because they have no growth, 12 million becomes your cash flow. 20% is your cost of capital because you have no debt. 12 divided by 0.2 is 60 million. So the value of this target company is 60 million. Everybody with me so far? Because now I'm going to try to get you to pay more. I'm the banker. I'm trying to get you as an acquiring company to pay more than 60 million to do this acquisition. But I want to make sure everybody's on board with the 60 million. Okay. So now comes the first test. You're the acquiring firm. Okay. So you're looking at this target firm, which is just valued at 60 million. You're an acquiring firm. You're in a much safer business, and you have a 10% cost of equity. I show you the target firm that you just saw on the previous page. What is the value of the target firm to you? Oh, it's still 60. Paul, come back on. Because Brooke said 120 because she's saying 10% cost of equity. So Paul, come back on, tell me why it's still 60.
So I'm just thinking of it like it's a project. So if you value a project, you're not valuing your company, you're valuing that specific project.
And the rule for a project is the discount rate for a project should reflect the risk of that project, right?
Yeah.
Which means in this case, you're buying a risky company. You can't use the 10% cost of equity. Because if you use the 10% cost of equity and you pay 120 million, you're overpaying. Because you're paying for a risky project using your safe company's cost of equity. You want to hear some bad news? 50% of all M&A deals are fundamentally flawed because the acquiring company's cost of equity and capital are used in valuing the target company. There are some principles in valuation where I'm willing to concede and give. This is not one of them. You violated a first principle in valuation. You have to use the 20% cost of equity. Yeah. Anybody want to push back? Ayan, you said 120. Do you want to give me a rationale for 10% or have you changed your mind?
Professor, I had a question.
Yeah.
You know how when we value private firms, we looked at it, like the value depends on the buyer.
Yeah.
But then, why would the value of a private firm change?
This has nothing to do with buyer or seller. I'm using the same beta still, right? Think of it as using the same beta. What's happening here is, in this case, the acquiring firm is a much safer firm. It has a much lower beta, different business. So this is a safe company buying a risky company. There you had the same company. The risk was the same, but the buyer was not diversified, so they had to factor in more risk. And even there I said, if you have multiple buyers, who's going to be the winner? The most diversified buyer, because they can pay more. Once you're in the public company domain, every investor is diversified. You can't bring in differences in diversification. The only reason the cost of equity is different across these companies is one is in a risky business and the other is in a safe business. So you can't subsidize risky businesses by paying them more because you're a safe company. Because if you do that, here's what's going to happen. You're going to buy risky business after risky business, thinking they're bargains. And at the end of the period, you're going to look back and say, what the hell did I just do? Because they're all going to blow up on you. Because the risk isn't going away. You can't endow risky businesses with your safety as an acquirer. So first rule in acquisition is when you value a target company, it's the target company's beta that should be used to come up with the cost of equity, not the acquiring company's beta. Raphael, you had the mic open and then you shut off. Cole, do you have something to add?
Wondering, what if the risk comes from the company's capital structure?
That's a good question. Can I hold off on that? Because you're saying, what if the target company could have borrowed money, but they chose not to borrow money? What if they were underlevered? I'll come back and address that under the value of control. That's a different issue, right? Because you're not arguing that you give the target company the capacity to borrow money. You're just saying they're not using their own debt capacity. That's a little different. We can talk about who should get that value. But this is, think of it purely from the perspective of risk in different businesses. You're a safe company. You can't acquire a risky company and use your company's cost of equity. Yeah.
I was also thinking of the other way around. Let's say they're over-levered and you have access to capital markets at a much lower cost of debt. It'd be possible to purchase a distressed company and you're actually, getting some benefits from your cost of capital.
But it's coming from moving them to the right debt ratio. Again, the key is render unto the target company that which is theirs, not something you bring to the process. So if a target company is mismanaged, it has too much debt or too little debt, we can talk about how by taking that company over and setting the debt ratio right, either by bringing it down or bringing it up, you can increase the value of the company. That's a value of control. And we can talk about who should get that value. But let's hold off on that and think first just in terms of risk in the company, risk in the target company. Because when you bring debt into the equation, you're bringing in issues of, is the company well managed? Is it correctly levered? And that's a discussion I want to hold off until when we get to part 2 or part 3 of this particular test. Yeah, go ahead.
Thank you.
Who's talking? No? Okay. So that's the first thing. So the first test is make sure as an acquiring company, you always look at the target company's unlevered beta, what business they're in, to come up with a beta and a cost of equity for the target company. Let's move to a second test. Let's say you as an acquirer have access to cheap debt. So this is actually Dave's question in the chat, and I'm going to put Dave on the. So you're an acquiring company, you have access to cheap debt. You plan to fund half the acquisition with debt. Why? Because you have excess debt capacity as an acquiring company. You're a very conservatively run company of debt capacity. So you're borrowing money using your debt capacity at a really low rate. And you're going to use half of the money that you need on this acquisition is going to come with debt. Dave, unmute yourself because I'm going to put you on the spot and you're going to lead me through the numbers again. So work out just purely, if you're the banker, I'm now telling you 50% comes from debt, 50% comes from equity. The equity costs you, let's say 20%. Let's keep it at 20. You should unlever and relever the betas, but let's leave it at 20. So half your money comes from equity at 20. Half of it comes from debt at 4. Technically, what's happened to your cost of capital? 50% times 4 times 50% times 20 is?
12%.
12%. And if I work mechanically, I would take the 12 million that I had as cash flows divided by 12%, which gives me a value of 100 million, right?
Yeah, 100 million.
So let's say I pay that $40 million premium on the acquisition. Have I done the right thing as the acquiring company's management? I paid a premium. Why did I pay the premium? Because I was able to borrow money at a really low rate using a debt capacity I had earned as an acquiring company. You see how unfair this is to your own shareholders? You're taking something you've spent decades building up, this high bond rating, the fact that you have excess debt capacity, and by paying the premium, you've transferred that wealth from your stockholders to the target company stockholders. So this isn't the target company being able to borrow 50%, it's you having the debt capacity and the access to cheap debt, and you using that as an argument for paying a premium. You're just transferring wealth again from your stockholders. So I know bankers do this all the time. They take the acquiring company's cost of debt. They use the debt ratio on the deal. And they don't stop and ask, where is that debt capacity coming from? Because if it's coming from the acquiring company, you shouldn't be pumping it into your cost of capital. I've actually seen, and you might not believe this, I've actually seen target companies valued with 100% debt ratio. You know how that happens? Can you acquire a company entirely with debt? Absolutely. You're a big acquiring company of debt capacity. I can borrow all of the money I need for an acquisition. So here's the perverse logic that the people have used to come up with just the cost of debt as the cost of capital. They say, you're funding this acquisition entirely with debt. So I'm going to put a 100% debt ratio. You're able to borrow money at 3%. So I'm going to use a cost of capital of 3%. You know what happens to your value as a company if I use a 3% cost of capital? It goes through the roof. I pay that as a premium. Think of the disservice I've done my stockholders. So this is a trickier test than the first one because you can borrow the money, you have the debt capacity, saying, why should I use it? I'm not stopping you from using your debt or paying the 4% rate. I'm saying don't build it into the value of the target company because this doesn't belong to the target company shareholders. Let me pause and make sure everybody's on board with that second aspect. So whenever you value a target company, look at the beta of the business the target company is in to build up to a beta. And when you think about debt ratios, don't just look at how the acquisition is funded because often that can come from the acquiring company having a debt capacity and access to debt. You still have to stay focused on the target company. Dave, go ahead.
I just have a question about this process in general.
Yep.
Currently, we're using the value that we're using is based off like an intrinsic valuation. But technically, couldn't you say that this entire process is
a pricing process?
Market?
You know, and
Yeah.
in fact, we're going to. That's what I'm going to look at in part 5 because you might say, look, all of this is kind of academic because if I want to acquire another company, I've got to price it. But then you got to explain to your stockholders why you're playing the pricing game because you're acting like a trader, right? And you're acquiring. I mean, it's one thing for an investor to say, I'm going to price companies and I'm going to buy companies based on pricing. You know what the problem with doing this in an acquisition process is? What's the end game in pricing? You buy at a low price, and then how do you make money? You sell it to somebody else at a higher price. So unless you're the kind of acquiring company that wants to flip target companies, and very few acquiring companies do M&A with that in mind, it's a very dangerous game. I agree with you. Pricing enters M&A, but it's almost the wrong place to be using pricing, right? Because as an acquiring company, what do you get? You get cash flows from the target company. That's what you acquire the target company for. So while acquiring companies often use pricing to justify acquisitions, it's a very dangerous. You're in very dangerous ground, because you should not be using pricing in the first place if you're an acquiring company and you're buying businesses as part of the value of your business. So, any other questions on the debt issue? So let's move to the third test. Remember I said in most M&A houses, so Connor's going to find this out, Anshu's going to find this out, as you go work for an M&A bank, in an M&A group in a bank, you'll be taught, this will be built into your training process. You'll be told to add a control premium. And you'll be given a number, 20%, 25%. And if you are brave enough during that training program to put up your hand and say, where are we getting this 20 or 25%? The answer you're going to get is, just take the number. It's what we always use. So I'm going to give you some insight into where this 20 or 25% originally came from and how it's become part of the process. There's this database called Mergestat. I think we have access to it at Stern. And Mergestat is not fancy. It collects data on every merger done. It used to be just the US, but now it's a global database. And here's what they list. They list the market price of a target company before the acquisition was announced, and then they list the price at which the acquisition was done. So let's say company B was acquired. They'd say the market price, the market cap before the acquisition was $1 billion. It got acquired at $1.25 billion. And they estimate the premium. 1.25 billion is a 25% premium. And they call that a control premium. Terrible word for it, and I'll explain why. But they do that for every deal. You know what that average premium has been across all M&A deals over a long time period? About 20 to 25%. So you see where the number comes from. It comes from looking at past deals and saying, hey, historically acquirers have had to pay 25% more than the market price. That's a premium. You say, why not call it a control premium? Because what else do you pay a premium for? You pay for synergy, you pay for control, you pay for stupidity if you overpay. So basically, when you take that premium and you call it a control premium, you're already kind of attributing the entire premium to control. So that's the first problem. The second is we know companies consistently overpay, at least on average overpay. So we take the average premium paid on past acquisitions and we build it into our own acquisitions. What are we going to do on every acquisition? We're going to be inclined to overpay. So let's step back from this 20% premium. In fact, it's funny because about 4 years ago, the chancellors of the Delaware courts are the ones through which most M&A cases go through. So they gathered together in UPenn and they had a seminar, and they asked me whether I would come in and talk about the control premium, because bankers coming in front of the Delaware courts kept using this control premium and they want to know, what is this 25% they keep using? So I went in and did a session on control. So I'm going to give you a mini version of that session. Let's assume you have a company, and remember the target company I showed you that had a 20% margin, $12 million in after-tax operating income. Let's assume that this company could be run better. Better in what sense? They could cut costs, they could have a 30% margin. What's the value of control in this company? Run by the existing management, it's worth $60 million, right? If you ran it with a 30% margin, what's going to happen to the value of the company? The 12 million will become 18 million, the 20% to 30% margin. With an $18 million after-tax operating income, the value you'd get for this company would be about 90 million. The value of control in this company is 90 minus 60, which is 30 million. You see where I'm going? If you want to value control, you've got to do it right. And to do it right, you've got to take the target company and say, if I ran the company, or somebody who knows how to run things ran the company, what would the margins look like? What debt ratio should they use? In fact, with this target company, perhaps they shouldn't be all equity funded. Maybe they should be 20% debt, 80% equity based on their capacity to borrow money. I would revalue the target company using the higher margins and the lower cost of capital. And of course, I'm going to get a higher value. So, is there a value of control? Yes, but it arises only if you believe the target company is badly managed and badly run. And it definitely is not 20% for every target company. In fact, as a limiting case, if your target company were perfectly run, what control premium should you pay? 0. Now do you see the danger of attaching a 20% premium for control in every target firm? I mean, some of these firms should be paying 100% premium, some you shouldn't be paying any premium, and you're just automatically putting a 20% premium. So to value control, you really need to value the company twice. And we're going to spend some time on that next week when we talk about, because most of you have done a value of your company. Think of that as a status quo value. With the existing management in place, you need to revalue the company with somebody more competent, more efficient. We'll talk about how to come up with those numbers. But to value control, you got to do it right. So here's the lesson I draw by looking at that control premium. You look at M&A, you see arbitrary premiums for brand name, for control, for quality. Why? Because you want to justify the unjustifiable. Often people will act like these premiums are facts. They'll say, of course it's a premium. Look, it comes from merger stat. Don't fall for that. Just because merger stat finds a 25% difference between what's paid on acquisitions and the market cap before doesn't make it a control premium. And let's face it, if you've done your valuation correctly, you can incorporate the control premium into your value. So if I use a 30% premium and I use the lower cost of capital reflecting what the target company should be borrowing, it's already got the control premium built in. I shouldn't be adding an extra premium on top. So be careful about control premiums. You're going to see them used around you, and often you're going to see them misused to justify really bad deals. Any questions on control premiums? Go ahead, Tim.
Yes. So, how would you go about the fact, however, that when you're trying to buy a company, you have to pay a certain premium to get
Let me ask you a question. Why do you start out with saying you have to buy a company? Who held a gun to your head and said you have to buy a company?
Okay.
And that's, I think, the problem. People decide that they have to do an acquisition of a target company. And then they say, well, I have to pay a premium. Because once you make that first decision that you have to buy a company, of course you're in trouble, right? That's like going to an auction and saying, I have to win the auction. Of course you'll win the auction. What do you have to do? Pay more than everybody else does? So in a sense, that is part of the problem. And I'm glad you said that, because in many companies that do M&A, that becomes part of the problem. It becomes a mindset. Remember I called it an addiction? You have to do the acquisition. And once you've made that the first decision, everything else is screwed up.
Okay, but then as a follow-up, if you do your evaluation and you see that like an acquisition could be beneficial, but then you have to, but you know that the majority of shareholders will only agree to sell their shares if you pay a certain premium.
Now, we're going to back up. When you say beneficial, what are you talking about?
So I'm saying maybe, for instance, using the right discount rate, etc., you see that there's actually a positive net present value.
So you could buy the company for less than it's worth. Is that what you're saying?
Correct.
Okay.
Correct.
Then what's the problem?
But you find that, but in order for the majority of shareholders to agree, you have to. Well, then
your basic starting point already went away, right? Because your definition of a good deal is the price has to be less than the value. If you say I have to push up the price to get the deal done, and you push the price up above the value.
Well, that's my question. Yeah. Are you allowed to do that? Probably not, right?
No, of course not, right? Because if you push the price up above the value, that the original premise goes away. It's no longer a good deal. The definition of a good deal in acquisitions is not whether there's synergy, not whether there's control, but whether you can buy the target company at the right price. So if the price keeps getting pushed up, you know what you need to do, right? You need to walk away from the table. And that's where I think we run into a problem. Is once you get to that M&A table, your ego gets in the way, your bankers get in the way. It gets very difficult for acquiring companies to say, you know what, the price has got too high. We're walking away. That's why it's so interesting that you might need a crisis for something like that to happen. You know that Victoria's Secret was there. You know, there was an announcement. Somebody in the class might be valuing, you know, the L Brands, which owns Victoria's Secret. There was a deal to buy Victoria's Secret in February of 2020. So the deal had already been signed. The price had been set, and now LVMH wants to back out of that deal because I don't know who the acquirer is. Maybe it's not LVMH. Whoever the acquirer is wants to back out of the deal because they think the price is now too high. I don't know whether they'll legally be able to do that, but you almost never see that happen. So when you see it happen, you know that it has to be a crisis, because you almost never see companies walk away from deals because the price got too high. And in any rational, logical world, you should see a lot more acquiring companies walk away from deals when the price gets too high. Dave?
My question is, what if your purpose of your acquisition isn't for growth purposes or for cost savings, but rather for thwarting like a competitor from rising up?
It's still a cash flow effect, right? So what does thwarting a competitor do? It gives you higher margins. It keeps it. So basically, it's still a cash flow effect. It's just a defensive cash flow effect. You're saying if I don't do this, I will lose market share or my margins will drop. You'd still have to compute a cash flow effect, right? It's like a cost saving capital budgeting project where you're not taking a project because you think it'll increase value, but you're trying to minimize your costs from doing it. So it's still a cash flow effect. I can compute the present value of what you will gain by doing it, and then you have to compare it to what you pay to do the deal. But I'll tell you, if you're doing a lot of defensive acquisitions, and I'll come back and talk about this, you're already in a bad business. And that should be a signal to you that maybe this is not the business where you're going to fight to keep your market share.
Okay, but like the example I'm going to use is like Facebook and Google. They do hundreds of small acquisitions.
Oh yeah, but they don't buy companies. They buy technologies. In fact, they're very disciplined. Facebook's two big deals have been WhatsApp that they bought for 19 billion. That's the biggest deal, and Instagram. I'm sorry. Is it Instagram? Yeah, Instagram for $1 billion, right? And Facebook has actually created value from both of them. WhatsApp, it's deferred value, right? Because they've, in a sense, still not monetized WhatsApp. But if you're in WhatsApp, it's coming. I mean, all of my, in India, everybody uses WhatsApp. They use it for the phone calls and messages. You're being dragged in further and further into the Facebook ecosystem. And it's only a matter of time before Facebook says, let's monetize WhatsApp. So I think if you look at an Apple, for instance, has never done a big acquisition. So when you think about 19 billion, it sounds like a lot of money. But remember, if you're a half a trillion dollar company, which is what Facebook is, 19 billion is not that big a deal. And it was a private company. It wasn't publicly traded. So they could negotiate the price they paid. And we can talk about whether that price was too high or low. But this becomes a problem when you buy public companies, because public companies, you pay market price plus, and that's where the tendency to overpay becomes greatest.
Oh, okay, I didn't know that. Okay.
So let's ask a question about synergy. Let's say that and there's fake synergies and real synergies. Let's talk about one of the fake synergies. Let's suppose that you have two publicly traded companies, okay? Company A, Company B. And A is acquiring B. And the manager of company A say, look, we're doing this acquisition because we want to become less risky. You see how this works here? With a steel company buying a chemical company, the combined company in a sense is going to be less risky because you're in two different businesses. It's an extension of that, two asset portfolio thing that you start every diversification argument with. In other words, you're using diversification as your argument for doing an acquisition. I think it's a terrible argument. Tell me why it's not going to create value. Why would acquiring another publicly traded company, just because it will make you more diversified and less risky, not create value in most deals? Paul, you have the right answer, so why don't you unmute yourself and tell me. You said shareholders can diversify on their own. Explain to me how that's going to be cheaper than a company doing it for you.
Yes. So basically, instead of the company acquiring so steel and oil, the shareholder would just buy stock in an oil company.
And why is the shareholder always going to get a better deal than a company is?
Well, I can just go buy it at the market price, and if you have to play market price plus,
Yeah.
I can do it better than you can. Obviously, as history shows.
Absolutely. In fact, I mean, when was the last time you paid a 25% premium on the price? Can you imagine going on E-Trade and offering $12.50 for a stock trading at 10? You'd be out of your mind to do it. But that's exactly what companies do. They pay a premium. So if your entire motivation for doing an acquisition is, oh, we're going to get less risky, I'm going to say stop, right? Because the risk you're eliminating is firm-specific risk. And if you're already publicly traded companies, I can do that myself. I don't need you to do it for me. So synergy almost never shows up in the denominator. You know what I mean by the denominator? In a DCF, you got cash flows in the numerator, cost of capital in the denominator. So when you see synergy, it's almost never. There are some very unusual cases we can argue you can get a lower cost of capital, but synergy almost always shows up in the numerator. In what form? It can take the form of higher growth. It can take the form of lower costs. Okay? So basically the mechanics, if you think about the levers I've used to value companies, are going to show up as higher revenue growth, perhaps higher margins, maybe lower reinvestment if you get economies of scale in investment. It's almost never going to show up as a lower cost of capital. So when you think about synergies, think about cash flow synergies, because that's really where the bulk of synergy value comes from. Okay? So let's assume you do have cash flow synergies. And let's say the cash flow synergies are 200 million in a deal. So you're the acquiring company, you value the synergies, you've done your homework, right? Should you pay the $200 million as a premium? Do you see what I'm asking? You value the synergy. Should you add that on to your target company's valuation and pay that as a premium? Dave, go ahead.
No, unless you discount them by the cost of capital. Over
No, you've already discounted them. So basically the premium is a present value. So you've done it all right. The 200 million is a time value, it's present value. You've done all of that. Would you then pay it as a premium? In fact, if you paid the entire 200 million as a premium, what have you just done? You've created a zero net present value investment, right? And what happens to your company's shareholders when you take a zero net present value investment? Nothing. So you do all this hard work, you create synergy, and who's getting all the benefits? When you pay it as a premium, who ends up getting the benefits? It's a target company. It's a target company shareholders. So if you value synergy at 200 million, remember you need both companies to coexist for synergy to actually show up in the first place. You should negotiate for your share of the 200 million. On what basis? You're bringing some strength to the table. So if you're an Indian company buying a US company and the synergy is going to come from the combined company being able to sell more stuff in India. Let's suppose the US company's products can be sold more in India. You have to say, look, I am bringing the distribution system. I have the strengths in India. I should be entitled to 40% of this premium or 50%, depending on how much you think you matter in this process. And you should be negotiating for a share. I almost never see this in M&A. Because companies don't even try to value synergy. It's almost mixed in, messed up. So if you ask most M&A bankers, well, how much of this deal is synergy? They'll say, well, it's somewhere in there, but I can't tell you where it is. If you don't know how much it is, then how do you negotiate for your share? So even if you believe there is synergy, it's your job to actually try to value that synergy and then ask how much of that synergy should we claim as the acquiring company shareholders. So any questions on this bargaining? Because ultimately you want to keep some of that synergy for your shareholders. So now let me give you the different ways in which synergy can show up in a merger. When you look at synergy in a merger, it can take one of two forms. It can be operating synergy or financial synergy. Let's start with operating synergy because it's much more intuitive. Operating synergy can take the form of economies of scale. You know when this will show up is when you have two steel companies come together, two retail companies come together. Where are the economies of scale? Maybe you have two different distribution systems and you can live with one. Because economies of scale are the easiest synergies to value because they show up as cost savings and higher margins. So basically all you have to do is take two companies with 8% margins, combine them, and with the cost savings, the combined company has 10% margins. So when you have operating synergy, it takes the form of economies of scale. It shows up higher margins, higher earnings, higher value. You're done. The other form of operating synergy is growth synergies. And growth synergies can take one of three forms. It can take the form of higher returns on new investments. As a combined company, you're more powerful. You have stronger competitive advantages. You earn higher returns on new investments. That shows up as a higher return on capital and a higher growth rate. Remember, return on capital times reinvestment rate is the growth rate. Higher return on capital, holding all else constant, will increase your growth rate. Maybe it takes the form of more new investments. Your return on capital doesn't change, but you can make more projects. Why? Because you're in two different markets now. That shows up as a higher reinvestment rate and holding all its constant and a higher growth rate. Or maybe it doesn't even show up as higher returns on capital or higher reinvestment rate, but it lets you keep your return on capital above the cost of capital for a longer time period. Why? Because you have bigger competitive advantages. That shows up as a longer growth period. You see, mechanically what I'm trying to do, I'm trying to find something in my DCF that I can change to reflect your synergies. And operating synergies, it's almost always going to show up in the cash flows. Now let's talk about financial synergies. The most common financial synergy is the synergy you should never mention if it's the reason for your merger. You know what that is? Tax benefits. About a third of all M&A in the world, I think, is done because you get tax benefits from the deals. In what form? It can be a money-making company buying a money-losing company. Where's the tax benefit? After the merger, you can bring the losses into your company and save yourself on taxes. You can have, maybe some component of the tax code where it allows you to write up the book value of your assets. Why is that good? Because it gives you more depreciation. Depreciation gives you tax savings. So maybe it's lower taxes. Yeah. It could be, and this is one of those rare cases where you can have it show up in the cost of capital. Two companies with an optimal debt ratio of 20% each as standalone companies. But as a combined company, because they're safer, they have a 30% optimal, which allows you to have a higher debt ratio and a lower cost of capital. Or it could be diversification. You see, but we said diversification doesn't make sense if you're a public company. Remember with private businesses, we use total betas, and what drove the total beta was the correlation with the market. As you diversify across multiple businesses, guess what happens to correlation? It moves towards one, and as it moves towards one, you pay less of a penalty. So with private companies, there's actually an argument that maybe you should do acquisitions to diversify because your stockholder is the owner and the owner is not diversified. So financial synergy can take the form of tax benefits, added debt capacity, or diversification. Now, Dave has brought up a company that I've struggled with for the last 5 years, a company called Valiant. Dave, do you want to unmute yourself and tell me what Valiant's potential value creation strategy was? They did acquire a lot of other smaller pharmaceutical companies. Do you want to talk about what their strategy was in creating value?
I'm sure you know it better, but it was basically acquiring smaller biotechnology and pharmaceutical companies and hiking the price.
Okay.
Once they acquired it, they would hike the price of the drug or treatment and generate excess returns through that. But
in fact,
unfortunately,
you're on to the basics of the strategy, but I'll add one piece of finesse to the strategy. They bought other smaller pharmaceutical companies with drugs that had already been approved, had been out in the market 7, 8, or 9 years, and were for small populations. In other words, it dealt with diseases that only a few 100,000 people got, but this drug was essential for them. So these were established drugs for a small population where there was still 8, 9, or 10 years left in the patent life. So they buy these companies. The company's value would reflect the cash flows they were getting from these drugs. But right after they bought these companies, guess what they would do? Is they'd take the drug price and they would quadruple it. Some of you might have heard of this crazy guy called Martin Shkreli. He carried this to the logical end game and ended up in jail. But Valiant actually would quadruple the drug price. And remember, this treats a small population. You need the drug. Of course, you're going to have to pay the price. So basically, it bordered on an amoral or an immoral strategy. And as long as Valiant was able to stay under the radar, it worked really well. They increased their market cap as a company from about 20 billion to close to 200 billion. Now, in fact, Bill Ackman was a big investor in Valiant. He was in the board of directors. He helped pick the CEO. But you know what caused Valiant to blow up? The strategy worked as long as they stayed under the radar. You say, what do you mean under the radar? Well, this is not exactly a strategy that's great for PR, right? If you told the market, look, this is what we do. We buy drugs that people need, and then we quadruple the price, and that's how we make money. It's not exactly a strategy you want to publicize. So as long as they were under the radar, nobody noticed. But then they got more successful, and they got bigger, and they got even more successful. And they now had to do it on bigger drugs that treated more people. And they were doing the same thing they did with the smaller drugs, but now you had 2 million people affected, not 20,000 or 100,000. So at some point, people started noticing. Like who? Politicians started noticing, insurance companies started noticing, and that was the start of the end for Valiant. Because once they started noticing, people said, that's not right, you can't do that. Politicians started talking about passing laws, and then people started digging into how they were able to get insurance companies to pick up this higher cost. And it turned out that they created this set of private pharmacy suppliers that allowed them to hike up prices. So there was a whole structure they built on the model that once you were held it up to the daylight was no longer a viable structure. Valiant fell apart. The 200 billion became 25 billion. And in fact, the name of the company got so contaminated. You know what they had to do? Dave, do you know what the rest of the story was? What happened to Valiant?
They just changed the. I forgot the name they changed it to, but
they changed it to the name of one of their subsidiaries. You know what their subsidiary was? Bausch and Lomb.
Yeah, Bausch. Yeah.
So they're now called Bausch and Lomb because it turned out that the name had become so contaminated that their R&D department, they lost every scientist because they said, we're not working for you. So this is actually a story I tell about, if you talk about the potential, when I talk about ESG, I'm a cynic on this because I think it's a buzzword. But I do think companies should try to stay on the right side of what people think of as this is a good company, because Valiant in a sense played on the wrong side until they got noticed and the whole company blew up. So their synergy was, hey, we'll buy underpriced drugs and we'll hike up the price. But it's not a scalable strategy because once people notice, that strategy is going to blow up, and that's exactly what happened at Valiant. Any final questions about this page before we kind of go in? So let me finish at least the synergy part. So if you're asked to value synergy, here's what you need to do. You first need to value the target company and the acquiring company as standalone companies. Let me repeat that again. You cannot just value synergy in the target company. You have to value the acquiring company and the target company as standalone companies. Step 2, just add those two values up because you're going to get the value that you would get for the combined company with no synergy. In step 3, here's what I want you to do. Take the combined company, throw in everything that you see as synergy into that valuation. What am I talking about? If you think this combined company is going to have higher growth, throw in the higher growth. If you think it's going to cut costs, give it higher margins. If you think it's going to be able to borrow more, give it a lower cost of capital. Then value the combined company with all those synergies built in. And what should happen? If those synergies increase growth and lower costs and lower your cost of capital, you should get a higher value in step 3 than you got in step 2. The difference between the two values, the value you got in step 3 to the combined firm's value in step 2 is the value of synergy. So I'm going to give you an example. It's a very simplistic example from a long time ago. But 15 years ago, Procter & Gamble, at that time the largest consumer product company in the world, bought Gillette. You're all familiar with the name, it's a big brand name company, but a company that had been around a long time, mainly focused on razors and shaving related products. So at the time that the deal was done, there was talk of synergy in the air about how the combined company was going to be able to grow faster and create value. And I said, I'm going to try to value synergy. So here's what I did. I first valued Procter & Gamble. So I took the pre-acquisition numbers and I valued Procter & Gamble as a standalone company and I got 221 billion. I valued Gillette as a standalone company and I got about 60 billion. Let me pause right there. If there's no synergy, the value of the combined company should just be the sum of those two values, 281 billion. So think of that as my combined company with no synergy. I kind of made up a name. I said Procter & Gamble plus Gillette is Piglet. That's not the name they picked. They chose to stay with Procter & Gamble. But no synergy, the value is 281 billion. Then I said, okay, let me build in the synergy benefits. So mostly the synergy we're talking about is how the combined company could grow faster. I gave them that higher growth rate, 12.5%. And I revalued the combined company with lower costs. So basically their operating expenses were reduced by 250 million. That increases my operating income and cash flow and higher growth rate. So with operating expenses reduced by 250 million, a slightly higher growth rate, the value that I got for the combined firm was 298 billion. You take the difference between those two numbers, I valued Synergy at 17.2 billion. It's a lot of value, right? So you think Procter & Gamble made money on this deal? Or created value? What have I not told you? Procter & Gamble buys Gillette, the premium paid. They paid a $25 billion premium. So Connor, help me out here. If you're a Procter & Gamble shareholder, and Procter & Gamble is paid $25 billion for a deal where the synergy is worth $17.2 billion, the day after the deal, what's going to happen to the value of equity at Procter & Gamble?
It will go down.
Buy?
Sell.
But the difference is like taking a negative net present value project with minus 8 billion as your NPV. The day you announce the deal and you say, I'm going to pay a $25 billion premium. Remember those acquiring company shareholders? We saw that, you know that 55% of all M&A deals, the acquiring company stock price drops when it announces the deal, and sometimes by a pretty significant amount. This isn't a bad deal. If you think about value created, it's a bad deal because you paid too much. A few years ago, I was asked to teach an M&A class and I refused. I said, what am I going to teach? Because it's a valuation class and we already do it. And they said, what you can, because you said, what do you fill an M&A class with? Deal making details. The problem with M&A is you spend too little time talking about the price and too much time talking about the fit and the strategic, components and the synergy and the buzzwords. But there's so little time talking about. Let me tell you my priors. At the right price, I will buy any company. At the wrong price, I don't care if you find the perfect company for me. I'm going to lose on that deal. The problem in M&A is not that there's no synergy or that you can't value synergy. It's that people pay too much. And once you do that, all else is lost. I don't care how great your fit is and what you show me. It's not going to work out. So any questions on synergy? So let's talk about one final example and then we'll end for the day. Let's assume that you're Best Buy. Best Buy, right? And this is the last days of Zenith, legendary TV maker. But by the time Best Buy is looking at Zenith, nobody's buying Zenith TVs anymore. It's a brand name and it's on its last legs. Nobody cares about the brand name. But here's the only plus that Zenith brings into the process. It has an NOL of $2 billion. You're in bad shape as a company when the only asset you can offer is, I've lost a lot of money in the past, but that's all Zenith is offering. So I want you to be my advisor. I'm Best Buy. I know what I'm getting with Zenith is this $2 billion NOL. If my tax rate is 36%, what is the tax benefit I get from this deal? Or what is the value of this deal to me? Basically, the only thing I'm getting is an NOL of $2 billion. My tax rate is 36%. What's the value of that tax benefit? Anybody want to try? Because I saw. So $2 billion NOL, 36% tax rate. 36% of 2 billion is how much? 720 million. My tax benefits are basically the only reason I pay the deal, 720 million. But here's a catch. If I have only 500 million in taxable income every year, what's the value of the tax benefits? How much am I going to get in tax benefits each year then? 180 million each year for the next 4 years. I have to compute the present value of 180 million each year. So my final question for today is, what discount rate should I use to discount those $180 million tax benefits back to today? Anybody want to try? Because I've seen investment bankers screw this up big time in terms of tax benefits. What discount rate should I use? Acquirer's cost of capital. You're very close to the right answer. Tell me why the acquirer. Usually we said it's all about the target firm. Why in this case are you looking at Best Buy? Because it was all about the target firm. Shouldn't we be looking at Zenith?
I just thought because you're buying basically the NOL and you're funding it with your cost of capital, so I thought
It's no, don't use the funding with the cost of capital, because for that reason you'd always use your cost of capital. What's the risk here? The NOL is no, right? There's no risk in the NOL. What's the uncertain number? The taxable income, right? That 500 million is an expected value. It could be lower or higher. The risk here is that Best Buy will not have enough income to cover the NOL. This is one of those few cases where the acquiring company's discount rate is going to come into play. You could actually argue that either the Best Buy's cost of capital or cost of equity, because the risk here is not in Zenith anymore. They've delivered the NOL. It's a guaranteed number in a sense. Your risk comes from, will Best Buy have the income? So the discount rate you would actually use would be the cost of equity or the cost of capital for Best Buy, depending on how levered they are. And if the market value of Zenith is 800 million, don't pay this as a premium, because this is your entire value. You can't pay what you've estimated as synergy value on top of a market price, because God only knows what's already incorporated in the market price. For all you know, that 800 million the market is estimating is entirely because of the tax benefits. And you can't pay a synergy or a premium on top of the tax benefit. So I'm going to pause there. And as I said, when we come back, we'll fill up the rest of the M&A process, depressing though it might be. And then perhaps look at some hopeful signs. There are few cases in M&A where you actually see value created. Now, Dave did ask the question, has a company ever underestimated synergy? Sure. I mean, you have thousands of deals. Sometimes you do underestimate synergy. But why? Sometimes let's say somebody bought Instacart in February based on expected cash flows. They're looking and saying, this is amazing. Or Zoom. Can you imagine if Cisco had bought Zoom in December of 2019? So hindsight can deliver all kinds of potential premiums. But that doesn't justify going out and doing a deal without doing your homework. Any final questions before I let you go? How do you get part B of the question? Which part B of what question there? Oh, the part B, the 500 million every year, just multiply 500 million by 36%, that's a 180 million. So instead of getting 720 million at one go, which is what you get in the first question, you get 180 million every year for the next 4 years, which is basically 720 million spread out over 4 years. Yeah. And on number 3, don't pay it as a premium. You can't just value synergy and pay it on top of a market value because you might be double counting. Yeah. Any final questions? Connor asked, do I think, no, Connor, why don't you unmic yourself, because I don't want to kind of just respond to that. So.
Yeah, I was wondering if you think private equity firms are better at kind of identifying value in transactions, both from an initial buyout and then the subsequent add-ons than, say, a banker would? They
do have one thing going for them, right? Which is one of the problems in acquisitions is the managers have no incentive because they're spending other people's money. How are private equity funds evaluated? They're measured on how much return they can deliver to their clients on their equity. So when they overpay, guess how it shows up? They get terrible returns. Their clients leave with the cash. There's more of an incentive of private equity investors to ask the right questions because they have more money riding on the deal. It's not other people's money. That's the first. The second is, in most private equity deals, it's not synergy that drives the deal. It's control. What's a typical target firm for a private equity company? It's not a high growth firm. It's a mature firm, which is, they perceive, badly managed. So what do? They go in and fix the firm, and then they flip it back to the market. So private equity firms, I think, have a greater incentive to be disciplined, but even they can wander off if they're not disciplined. So the KKRs and Blackstones are examples of successful private equity firms. But you know that 25% of private equity funds fold. They fail. And one of the reasons they fail is they overpay on deals. So they're less likely to do it, but they too can make those mistakes. Oh, Yui, sorry.
I just have one final question.
Yep.
Going back to the first point, when you're talking about bankers when they use the acquirer's cost of capital compared to the target company,
Yep.
which is wrong. What are the potential drawbacks that the bankers might say for the reasoning that they do that?
How would they justify it? I'll tell you how they justify it. We raise the money, so we should use our cost of capital. It's a very bad argument. But I think the problem is when you think of cost of capital, what do you think? It's a cost of my raising capital. That's really not what the cost of capital should be. It's an opportunity cost. So I think by misreading the word cost of capital, so I'm not even going to say they're being deceptive. They really are under the impression that the cost of capital is a cost to you of raising money. But in fact, the cost of capital used in valuation has nothing to do with what it costs you to raise money. It's a cost reflecting the risk of the cash flows, the opportunity cost. So I think part of it is just misreading what cost of capital means. So I think that reasoning can lead you down the wrong path.
I see. Thank you.
Okay. Cole has questions about HP and Xerox. This is a marriage of uglies. Two companies that are both bad companies. What happens when a bad company buys another bad company? You get a double bad company. I mean, doesn't mean the deal is a good one or a bad one, but I can't tell a good story no matter how hard I try for HP plus Xerox. Because neither company has much to bring to the table. Maybe they can minimize how much damage they can do over time, but that's my reading of HP and Xerox. I'll let you guys work out. Verizon and Yahoo, basically work through, Carl Icahn buying Occidental. I mean, you can work through anyone, but stick with the fundamentals. It's a good place to start whatever discussion we have. Okay. Ayan, last question for today.
Professor, I was wondering if we are valuing a company which is being acquired and there's a potential change of management, how will we account for that?
You can do it. Let me lead you through. So when you have change of management, where does it show up in your valuation? It shows up only if they change the way the company. So if you change management, if they do exactly what the old management does, what's the effect? Nothing. So first, when you have a change of management, the question you got to ask is, what will they change? They could change investment policy, which will show up in your growth rate and your margins. They can change the cost cutting, maybe they're more efficient, which will show up in margins. They can change maybe the debt mix, maybe the company is not at the right, which shows up in your cost of capital. That's what you need to do. Is when management gets changed, you need to ask the rest of the questions. What's going to change in the company? And after you've answered the questions, you got to revalue the company with the changes put in. And if the management is changing the company in the right direction, what should you find? The value of the company with the new management is higher than the value of the company with the old management. But you need to go back, and that's why I think it's sometimes when people say, well, when Best Buy got a new CEO and the stock price jumped 12%. And I said, what are you guys doing? What do you think this new CEO is going to do at Best Buy? This is a dead man walking, a zombie company. What exactly is he going to do at the company? Unless you can tell me specifics that a new CEO can bring into the company, I'm not going to be attaching a premium, because without putting those specifics in, the company is not worth any more money.
Thank you, Professor.
Okay, so I'm going to end for the day, and I will see you on Monday. And expecting my nagging to increase, it's already been terrible, but it'll get worse because we're only 10 days left before the final project is due. So I'm going to push you to get your numbers into that Google shared spreadsheet that I sent the link to yesterday. You say, what Google shared spreadsheet? Take a look at your emails, because I want your numbers to start popping up there, because you're getting pretty close to the end here. And you should at least have your DCF, because most of you have sent your DCF back. Some of you never sent your DCF to me, which is fine. Put your DCF value in there. And if you get your pricing in, put that in as well. And most importantly, don't forget the recommendation, buy, sell, or hold. And I want that Google shared spreadsheet to be filled up by the end of next week. We have 10 days, so you have time. But start putting the numbers in. But I will talk to you later. Take care.
Thank you.